G'day everyone, welcome back to Pete's Investing. And today we'll be looking at some top US dividend stocks and their growth potential. First, we're not offering financial advice, it's purely an educational video series to better your trading. And don't forget to hit the subscribe button, the notification bell and the like button, and also refer to our indices playlists, our share price reviews, and also our strategy playlists. That's where we look at some simple trading strategies, the average down approach, and some money management ideas. So let's get started. First, I want to show you some stocks in terms of the top US dividend stocks that we're looking at. And again, these are not exhaustive, they're just a few of the stocks that we've picked, doing some Google searches. So what I've done here is identified the company, the codes, and also the dividend yields and when they're going ex-dividend. This also shows the profitability since January 2007 up until today, 14th December 21, and it shows profitability and also the maximum drawdown required, a number of contracts for each of those. And this up here is our trading strategy. So again, I'll explain this in a bit more detail, and let's look at some of these as an example. So let's look at I won't go through all of them in particular, but let's look at the lowest profit over drawdown percentage, which is 3M. So if we look at 3M, it started off with, this is our profitability chart up here. So it made just over $4,200 since 2007. And that's represented by that figure there. The maximum contracts is 4. And that's basically back here when we averaged down, we entered once. Each of these steps is the number of contracts we entered. So we entered one number of parcels there. Each of these are $2,000 lots. Second lot of $2,000 lots there, third and fourth, and then here where the steps down, it's where the trade closes. So we opened that trade there, and we closed it there, and we averaged down in that sequence. And most of this was all single $2,000 lots of trades. We had another 4 level of contracts entered, and at that point we averaged down as well. So, and also we look at the drawdown requirement. So the drawdown is calculated according to the software at 26.53, and that 26.53 is recorded in that spot there. So it basically looks at the profitability, the number of contracts at any particular, at the worst case period during since the start of 2007, and the maximum drawdown. So we look at the profitability over the drawdown total, and that's 39%. So that was our lowest result of these stocks. So that was 3M. Let's look at now the best result, which was Apple at 213%. So if we look at Apple, this did really nicely. It sort of took a bit of time to take off in the early 2000s, since 2007, but then it started accelerating during the teen years, and then really accelerated since probably 2019 onwards. You can see here the number of contracts entered, so $2,000 lots there, 2 and 4, so I only entered twice there, and that's represented by the 2 contracts there. It made 12,680 since 2007, so 12,680. Our baseline is 100,000, and our drawdown calculated was 1959. That's it. Now the drawdown, just so you can explain a bit better, is basically from the highest level of profitability to the lowest level. It's a bit hard to see in that little example, but that's so that from the highest level of profitability to how far it's dropped down. So that has been our best performer. And then you've got Caterpillar, Coca-Cola, McDonald's, Microsoft, and Procter & Gamble. And you can see there the results of profitability and the drawdown requirements. So overall, the profit was at 39,900. All of those combined, and the maximum drawdown was 52,000, so that's a total of 77%. We use this KPI with all our back testing to see what level of risk we're taking on for the level of profitability. And obviously the higher the percentage, the better. Now in terms of the strategy we're using, we're looking at the Williams Alligator strategy, and we're looking at the alligator teeth breaking above the jaws, which is the blue line. So the red and the blue lines must be expanding. So what that means is, let's look at this as an example, and I'll find open and close trade back here. So let's look at this period here. So we open up our first, in this particular example, we open up our trade there, we buy there. You can see there the red line, red alligator teeth, breaks above the blue alligator teeth. We ignore the green line and the lips in this case, and I've also tested it against the lips breaking above the red, and there's very little difference, but we're using the teeth and the jaw in this case. So we wait until the red line breaks above the blue line, and then we enter the trade and what it's done there. So if you go back to the strategy and then you close it, when the close bar drops below the blue line, but you also must gain 10% minimum profit. So what that means is, you can see here, the red line, the close breaks below the red line, as it did here. So the red line there, it closes below the, see, it was the blue line. So before the closes below the blue line. So you can see there the close broke below that blue line, and we closed it out. Now we also look at making sure there's a 10% difference from when we first bought it. So if we buy in the close there, 10% was the minimum gain there, so it actually broke above there. Now you'll notice it closed there below the blue line, but it didn't. The close of the bar closed below the blue line, but the trade didn't close there. That's why it didn't close there. Whereas a few days later, it did close below the blue bar, but that was above the 10% line. So that's why that didn't close there, but it closed there. Now anyway, we put in that arbitrary 10% gain minimum for before we close our trade, and that's just so we get the best quality returns on our trading. You can put in there any particular percentage gain, so long as you factor in any potential brokerage that you may have. And again, we're trading $2,000 lots, each of these, and allowing for any brokerage. That's why we're allowing a 10% minimum gain of profitability. Now, the other averaging down logic, so that's our entry and our exit. The averaging down logic is simply the close is less than the average price. So let's go to an average down example. Let's look at this little example here. So we open up our first lot of $2,000 there. The price goes against us. Obviously the red closes below the blue, but we don't close out and exit the trade because we're not in a profitable position, and it's probably in a negative position at that point anyway. Well, it is in a negative position because the bar there is closed below that level. Keeps going down, and finally the red line breaks above the blue, and we enter another one. Now what are we saying here is we want to see a 20% downturn before we enter any more. So the close must be less than the average price, and we must go 20% downturn before we enter. So the way that looks is, if we draw in our ruler, we enter it in there. Let's draw. About 20% is about there. It just snuck in there. So that's just roughly drawn on this particular example. But you can see there it was a 20% decline, and it just made it into the it's just over 21% actually, so make it about there. So it actually broke above or just below the 20% decline, and that's where we entered the second lot of $2,000 lots. And our exit is the same on that one as well. It's just the same exit. The close breaks below the blue line, and we have a 10% minimum gain. So our average price now would have been somewhere in this area. And so that's not our average. That's not our entry price anymore. Our new average price is down there because we've averaged down. So our average is now in that area. That's our new break-even point, and we've got to have a 10% minimum gain. So that's well above our 10% minimum gain. Just eyeballing it. So we exit that trade. So that's pretty much the strategy in terms of entering, exiting, and averaging down. Notice we're not using stop losses, so we've got to be very careful with our funding, and we allow for the downturn and the averaging of the drawdowns to determine profitability, and we allow for a minimum 10% gain before we exit, and we allow a far enough drop for a downturn before we average down and enter new trades. You don't want to make that too small a percentage downturn. For example, you don't want to make it 5 or even 10%, because you don't want to get in too many times. You want to get in an optimal amount of time to give you profitability without going too much in the red when and if the market goes against you. Okay, I hope that's given you some ideas in terms of how we're trading this, but also if you want to trade some of the top dividend and US stocks, that's what you look at. But also don't forget some of our trading rules. Trading rules are: must buy proven blue chip stocks, avoid speculative stocks. If you want to trade speculative stocks, you must be trading a minimal amount of dollars from your account balance. Buy stocks which pay dividends. The reason you do that is because if you get caught in a sideways market and you're not closing out in a timely manner, then at least you're getting dividends from the investment you've made in the stocks you've bought. Don't short positions, go long. Now, why is that the case? Because this strategy can still work going short, but if you're paying dividends, if you're buying these in, if it's paying dividends and you're going long, you receive dividends. If you go short, you then must pay dividends to the people that are going long. So you don't want to you're probably already being lumped with charges if you're trading CFDs, but you don't want to be paying any extra costs that you probably can't afford. So you want to be receiving dividends if there are dividends paid. So that's why we try to avoid going short, although we can trade short. Do not trade on news. Price is already factored in the share price. So if a news article comes out tomorrow to say, for example, Apple is going to introduce this new phone, you can almost guarantee that share price has already factored that move in the share price. Again, don't forget to refer to the playlists, refer to our strategy and indices and blue chip share review playlist. Hit the like button, the notification bell, and see you in the next video.